If you buy individual stocks, you must learn how to read a cash flow statement. However, a cash flow statement can be really intimidating to look at, especially if you don't know what to look for. In this video, we'll take you through a cash flow statement line by line and teach you how to read a cash flow statement like a pro. My name is Brian Feroldi.
And my name is Brian Stoffel.
Thanks to Quarter for sponsoring today's video. Brian, let's start with the most obvious question. What is a cash flow statement?
A cash flow statement simply tells you about the movement of cash in and out of a company over a period of time. Now you might be wondering, isn't that the same thing as an income statement? Well, an income statement is governed by accounting rules, but a cash flow statement is governed by the amount of cash that goes in and out of your accounts. And for some people, that is a more reliable indicator of how business is doing than an income statement, which is governed by rules which can be difficult to understand.
One way to think about it is an income statement is kind of like an opinion of the cash movements of a company, and a cash flow statement is the actual cash movements of those companies. In some cases, those two things can be miles apart. Now, one key thing to know about a cash flow statement is, like an income statement and a balance sheet, not every cash flow statement will look the same from company to company. Management teams do get a little bit of leeway with how they organize and label things. However, all cash flow statements follow this rough guideline, and it's broken down into three main parts. On the top of the cash flow statement is the company's operating activities, which is all the cash movement in and out of a business from just normal day-to-day operations.
The next section refers to investing activities, and this accounts for cash that the company either generates or spends while investing into itself.
Final section of the cash flow statement is called financing activities, and this tracks the movement of cash related to debt, stock, or dividends. Now, at the end of the cash flow statement, the company is going to present the net changes in cash from all of the activities combined. And it's going to add that or subtract that from the cash at the start of the period and show you the cash at the end of the period. We actually think it makes sense to reorder these so that it looks something like this. You can think of it as the cash the company starts with, plus or minus the cash the company makes or spends during that period, and the end result is the amount of cash that a company ends with.
So let's go ahead and break down each of these three sections one by one, and we'll start with operating activities.
Now, the very first line item of a cash flow statement is net income, which is the bottom line item of the income statement.
The next section accounts for non-cash charges regarding the business. Now, what are non-cash charges? A couple examples can be depreciation, which is a value of an asset decreasing over time. An example could be your car. You know that the longer that you have your car, the less valuable it is. And you account for that in the income statement. However, there's no cash leaving your bank account as your car ages. And so that cash is then pushed back in the cash flow statement.
Another type of non-cash charge is amortization, which is the process of writing down the value of a loan or an intangible asset over time. That also is a non-cash charge, so that non-cash charge needs to be added back in since cash didn't leave the company's balance sheet to pay for that expense.
And finally, we have stock-based compensation. We see this a lot, especially with young tech companies that decide to pay their employees with equity or stocks in the company they hold. By issuing that stock, their company is not actually losing money. It is not paying it out of its bank account. So in the cash flow statement, the value of those stock-based compensations gets added back in.
The next expense is changes in working capital. What does that mean? Well, there's three broad categories of working capital. The first is accounts receivable. This is money that a company expects to collect from its customer, but hasn't yet collected. So if a company makes a sale to another customer on credit, but it hasn't yet received the cash yet, that increases the company's account receivable balance.
The flip side of that coin is accounts payable, and that is money that you expect to pay but haven't yet paid. The higher that gets, the higher your cash balance is because you're holding on to it while you wait to pay for the services or goods you've already received.
The final type of working capital is just inventory. This is the value of all the products that you have in your warehouse somewhere that haven't yet been sold. The higher that number goes, the lower your cash balance is. Conversely, if you sell off inventory, that increases your cash balance.
After accounting for all of these non-cash charges and changes in working capital, what you're left with is operating cash flow, or the amount of cash being brought in from running your normal daily business.
Next, let's take a look at investing activities. The first line item in investing activities is an important one. It's called capital expenditures related to property, plant, and equipment. This is more commonly called CapEx. And this is the funds that a company uses to buy, upgrade, or maintain its physical assets. And that can include property, machinery, buildings, technology, or equipment, etc. Capital expenditures is a key number for investors to know because it helps us calculate free cash flow. The formula for that is very simple. Operating cash flow, which is the bottom line from the operating activities, minus capital expenditures, which is the top line from investing activities. Now, capital expenditures is an important number for investors to focus on. The reason is by using capital expenditures and operating cash flow, we can do some quick math to figure out what the company's free cash flow is during a time period. To find that, we simply start by looking at the operating cash flow, which is the bottom number from the operating activities, subtracting out capital expenditures or CapEx, which is the top number from the investing activities. The difference between those two is a company's free cash flow during that period.
And going back to the earlier metaphor we used, a lot of people think that net income is how much profit a company brings in, but there are some investors that think that free cash flow is a more accurate figure because it is a fact that that much cash has entered the company's coffers.
For example, Brian, when we and you are breaking down a business, we pay much more attention to free cash flow than we do net income.
Exactly. Let's continue going down to the next line item, which is acquisitions. This is pretty self-explanatory. An acquisition is when you pay money or stock to acquire a company. And almost always, this is going to be negative in terms of cash flow because you're paying cash out to acquire the company.
The finite line item in investing activities is a positive number, and that is the proceeds from sales of investments that the company previously made. So if it sold out equipment that it previously bought or real estate that it previously bought, that would be a cash inflow. So that would be a positive number.
When all of that is said and done, we've got the next section complete and we know how much money was gained or lost as a result of investing activities.
Before we finish the cash flow statement, we want to give a shout out to today's sponsor, Quarter. With Quarter, investors get frictionless access to conference calls, investor presentations, transcripts, and earnings reports from markets all around the world straight to your pocket at no cost. Quarter's mission is to change the way that people look at investor relations and to create a completely new bridge between companies and its stakeholders. I love using Quarter because it's a free, easy way for me to listen in on all my favorite companies' conference calls while I'm on the go. If you're interested in giving Quarter a try, visit the App Store of your choice and download Quarter today for free. That's spelled Quarter, Q-U-A-R-T-R. Thanks, Quarter, for sponsoring this video. Final section is a company's financing activities. This is the cash flow of a business that focuses on a company raising capital and paying it back to investors through the capital markets.
The first section we have is regarding debt. Now, if a company takes on debt, normally that's seen as a bad thing, but in a cash flow statement, that means that more money is actually going into that company's coffers. If it pays debt back, that's considered a good thing. But in the cash flow statement, that lowers the amount of cash that a company has because it's leaving its bank account to be paid out.
Next would be any changes in cash due to the issuing or buying back of stock. This can be a positive number if a company is creating shares and selling them, or a negative number if the company is buying back shares and retiring them.
And finally, we have dividends. A company likes to reward its shareholders by paying out its excess free cash flow in the form of dividends. If it pays a dividend, that's usually considered a good thing by investors, but for the cash flow statement, it is a negative because it reduces the amount of cash that a company has.
Add all those activities together and you get the net changes in cash at a company due to financing activities. All right, Brian, time to run through a very simple example. Let's go back to the coffee stand that you own and show how that you create a cash flow statement.
Well, we'll start with operating activities. From the last video, we know that net income came in at $1,500. But let's look at the non-cash charges that the company might have had. The first one is depreciation. And we do have to account for that because I bought an expensive coffee roaster for this stand. And it's about $150 that came out of the net income statement, but gets pushed back in because we didn't actually pay money during the year because of it. If we look at amortization, there were no costs there. If we look at stock-based compensation, we did not decide to pay my daughter through stock-based compensation, so we can add in $150 there.
Next would be changes in working capital.
Right. So here we had $100 that hadn't been paid by the end of the year for a large order of roasted coffee beans. So I accounted for that as a sale, but in terms of cash flow, I had not yet received that money. So we're going to lose money there. When it comes to accounts payable, there were no bills left unpaid by us, so there's nothing to add back in. And when we look at inventory, we had about $500 worth of unsold beans at the end of the season, which means that we'll take out $500 from the cash flow statement.
So in your case, Brian, your accounts receivable and your inventory were actually consumers of cash, and that reduced your cash balance by about $600. So when we add all that together, Brian, your company generated about $1,050 in operating cash flow last year. That's a remarkably different number than the $1,500 in net income that you booked.
Let's move on to the next section, investing activities. This should be pretty simple for a simple coffee stand. And we'll start with capital expenditures. On that line item, we spent about $200 because we had to get a new tent to put over our coffee stand.
So that results in a net $200 charge to your cash. So now we have enough data to show your free cash flow for the period. So again, we look at operating cash flow, which was positive $1,050. Subtract that $200 in capital expenditures that you spent on the tent. So that gives us a free cash flow of the period of $850. That's only about 60% of the $1,500 in net income that you reported.
That's correct. And it really highlights how important it is to look at both the net income and the cash flow statement.
All right, let's keep moving on. Did you have any acquisitions during the time?
Unsurprisingly, we didn't acquire any other rival coffee stands at the farmer's market.
Okay. Did you have any proceeds from selling any investments?
No, we did not make any investments as a coffee stand.
So that gave us net cash used in investing activities of negative $200.
So for the financing section, we'll go through it really quickly because it's silly to talk about it for a non-publicly traded company. We didn't pay any debt or repay debt or purchase stock or pay dividends or anything like that. So $0 for financing activities.
But if we look at the entirety of the cash flow statement, here's what we see. You started out with $1,500 in net income. You had $150 in positive gain due to non-cash charges. You had $600 in negative cash due to changes in working capital. And that gave you operating cash flow of $1,050.
That's right. And for investing activities, we said that we spent about $200 on the tent, so we pulled that out for CapEx, but we made no acquisitions and there were no proceeds from the sale of investments. So we spent $200 in investing activities.
And as you spent zero on debt, zero on stock, zero on dividends, so that gives you a net cash used in the finance activities of zero. So if we add all that together, at the beginning of the period, you started out with $2,900 in your business. You had changes in cash flow of positive $850, and that left you with $3,750 at the end of the period.
All right. So now that we've got a very simple example out of the way, let's dig a little deeper into a real publicly traded company that many are familiar with called Netflix.
Netflix is my favorite example to showcases the difference between net income and free cash flow because they are miles apart.
If you want to find Netflix's cash flow statement, simply go to your favorite search engine and type in the company name and investor relations. In this case, Netflix Investor Relations. When the page comes up, you should be able to find somewhere that has the company's financial statements, which you see pointed out right here.
You can also sometimes find this information by looking at the most recent earnings report. Some companies do provide a cash flow statement with their earnings release. Otherwise, it would be in the most recent 10Q, which is the quarterly report, or 10K if it's an annual report.
All right. So one of the reasons we picked out Netflix is because, as Brian said, there are huge divergences in net income and free cash flow. In 2019, for example, Netflix reported net income of $1.9 billion. Sounds pretty good. However, if we look at their free cash flow, they had a loss of $3.1 billion. That's a difference of $5 billion. This isn't chump change. So what's going on here? Let's find out.
So here's what the company's statement of cash flow looks like. Let's start by zooming in on the operating activities. we see that the company reported $1.9 billion in net income. Sounds pretty good. But as we make our way down the cash flow statement, we actually saw that the company spent almost $14 billion on new content.
So that new content would be like, in this case, the final season of Orange is the New Black, or whatever new movie or TV show you saw that was produced in 2019. That's a lot of new content.
Netflix had to pay for all of that content up front because actors, directors, set designers all want to be paid while the content is being created.
However, at the same time, the company gets to add back some things because of amortization. In other words, all the money that they paid before was taken out at some point to be amortized, but really that cash was not leaving the company's statement. So it had $9.2 billion in the amortization of their assets. What does that mean? It means that in the net income statement, they accounted for the first 5 or 6 seasons of Orange is the New Black. Well, they weren't actually losing any money in 2019 because of that, because they'd already paid it. So all of those other seasons, you push the cash back in that you subtracted out in the net income statement.
There's several other line items in here, as you can see, but we'll skip over it and we'll just focus on the big ones. Another big positive contributor to operating cash flow was stock-based compensation. During the year, the company had more than $400 million in stock-based compensation expense. However, that was an expense that was a non-cash charge. As a result, we have to add that back into the company's cash balance.
What's the effect of all of this? Well, the effect, as we've already shown you, is that while it had 1.9 billion in net income, if we look at the cash generated or lost from operations, it was about a $2.9 billion loss. And again, almost all of that is accounted for in the depreciation or the change in those content liabilities and the amortization of their previous liabilities.
But remember, that's not free cash flow. To figure out the company's free cash flow, we also have to account for capital expenditures, which is the top line item in the investing activities. So if we checked out that segment, which is the next segment on the cash flow segment, we saw that the company spent $253 million on the purchase of property, plant, and equipment. Now we have enough information to figure out a company's free cash flow. So the net cash used in operating activities was negative $2.9 billion, and the amount of money that it spent on capital expenditures, which is property, plant, and equipment, was $253 million. You add those two numbers together, and in that case, we get free cash flow of negative $3.1 billion during the period.
Finally, let's look at Netflix's financing activities, which are actually very important because you might be wondering, how can Netflix afford to run their business when they're losing $3.1 billion? Here's how. You see that proceeds from the issuance of debt is $4.5 billion. Now, normally we think of taking on debt as a bad thing, and in the future, it can be a bad thing. But in terms of, again, just cash being put in the bank, because Netflix took on the debt, it was able to add $4.5 billion to its bank account.
So if we look at all of that together, during the year 2019, Netflix's cash balance actually went up by $1.2 billion, even though that was entirely due to the issuance of debt. So the company started the year with $3.8 billion and it ended the year with $5 billion. If you were just looking at the net income statement, you would say Netflix is wildly profitable. But by looking at the cash flow statement, you can see that the company is actually burning capital and relying heavily on issuance of debt to fund itself.
So what does all of this mean in plain English if you don't have an accounting degree? Well, in its simplest form, Netflix is saying, we're spending boatloads of cash right now. That's the cash flow statement. But then they're adding on to say, but here's why we think that's okay. The opinion, the income statement. Obviously, that has worked out quite well for Netflix, and it shows the value of the income statement. And you need to be able to balance what you see in both statements to make an investment decision that fits your portfolio.
Now, I was an investor in Netflix during this entire time period, and today Netflix is starting to actually generate cash flow, but there's no better example in my mind of showing the importance in the difference between the income statement and the cash flow statement than looking at Netflix financials. Well, we hope this video was useful to you. If you want to watch our other detailed videos on the income statement and the balance sheet, click the links that you see on your screen. Brian's out.